Thank you, Mr President. Mr President, did you realise that last year we shrank by 20%? I don't mean geographically. The general government, as at 30 June this year, is 20% smaller than was predicted less than a year ago in last year's budget. Not all of us shrunk, perhaps. At 20% smaller than the estimated outcome suggested in this year's budget only 3 months ago. 20% in this case is over $2 billion. That's why a preliminary outcome report was required. Section 26D of the Financial Management Audit Act 1990 requires a preliminary outcome report only when the final outcome is materially different from the estimated outcome contained in the budget papers. I think we would all agree that $2 billion difference for a state of this size of Tasmania is a material difference. But don't you think, Mr President, the reasons for the need for the preliminary outcome report should have been pointed out by the government? I wonder how many of us even noted the release of this report quietly on a Saturday with no indication this was occurring because there had been such a material difference in the estimated outcomes. The man in the street doesn't know the provision of the Financial Management Audit Act, an act which I might add is well overdue for major revision. I was assured this new bill is imminent, but I also recall a similar assurance from the previous government. Thankfully I did not, nor do I continue to hold my breath. However, some mail received in my office this morning up in Wynyard may well indicate that we might see this coming. We're in August now, yeah, in September. So anyway, we'll see. Mr President, if one were to take a balance sheet showing a 20% reduction in one's equity to a bank manager at annual review time, I'm sure the bank manager would have some questions to ask. Mr President, noting this report, I wish to comment on a few aspects that escape the notice of those framing the Treasurer's accompanying media release. The balance sheet is much smaller due mainly to two factors. First, the unfunded superannuation liability is much larger, and two, land, buildings, infrastructure and equipment are worth less. Partly offsetting these two factors, there's more cash on hand. At first glance, the unfunded superannuation liability has risen alarmingly. At second glance, I don't think it should give rise to increased panic. Future annual commitments haven't changed. It's just that due to the current low interest rate environment, the discount rate used to convert the future stream of superannuation benefit payments into a lump sum for accounts preparation purposes is a lower figure. And this means the liability is higher on paper. There's no more the government can actually do. One of its fiscal strategies, I think it's number 2, is that debt servicing costs, including paying the unfunded superannuation benefits, are no more than 6% of receipts, and that looks okay. The current strategy is a realistic acceptance that there is no alternative, and it's always been that way. Mr President, I've double-checked that back over the last 15 years, and there was only one brief occasion, and that was when we sold the Hobart Airport for much more than we expected, that the temporary borrowings from the old SPA account, ostensibly comprising funds to pay future unfunded superannuation benefits, was in excess of the nominal balance of the SPA account. In other words, there was never any cash in the SPA account, ever. Having debt servicing costs of 6% of receipts is still a lot of money. Mr President, most governments are actually worse off, Australian governments, and some overseas too. The second reason the state's balance sheet has shrunk is the value of its fixed assets. Our land, buildings, infrastructure and equipment is less than expected. In fact, it's hardly changed in the past 5 years. We spend on new items, depreciate existing items, and if a depreciation is not enough, an impairment charge is recorded. Overall, the value should be increasing. However, we are not even recording nominal increases, let alone real increases, and that's a worry. Mr President, depreciation is an operating expense. Extra impairment charges are non-operating amounts. Depreciation lowers the Treasurer's preferred measure of sustainability, the net operating balance. Extra impairment charges, or revaluations as they're called, appear as non-operating write-offs. They don't impact the net operating balance. A few years ago, in the 2010-11 year, the budget wrote off almost $1 billion in assets, mainly roads, and this occurred in the preliminary outcomes report also, when no one was looking. We should be told, Mr President, when these things occur. This year, in the preliminary outcomes report, the government adjusted the depreciation amount, decreasing it by $34 million, mainly because it realised that some of our roads were already written off. This, of course, made the net operating balance $34 million higher. But, Mr President, are we $34 million closer to sustainability? The government then found the Department of Education, Land and Buildings were $40 million overvalued and wrote off $40 million. However, this didn't affect the net operating balance figure, Mr President, as this is a non-operating amount. It makes the bottom line a subjective figure, a figure that can be fiddled. And that's why, Mr President, the net operating balance is always bandied about as a measure of how well we're going. The report reveals operating cash outlays, not including capital expenses, were also as budgeted. Operating receipts were higher due mainly to extra grants from the Australian Government. The net cash from operating was therefore higher due almost entirely to higher grant income. The government deserves a 7 out of 10 for the improved operating outcome, but we really should be properly informed about the full story. When one looks at capital expenditure on roads, hospitals and schools, we find that the government only spent $235 million out of a budgeted figure of $400 million. Of course, it means we have more money in the bank at the moment. However, almost the entire difference of $165 million comprises deferments, not savings. At a time when infrastructure spending would help boost the economy, the government has been a little tardy. The $32 million deferment relating to the Royal Hobart Hospital build is understandable, but not the rest. For its capital expenditure program, the government really only deserves a 2 out of 10. For the first time in my memory, the government has spent on what the government has spent on new capital has failed to keep pace with depreciation and sales of surplus assets. Despite shifting some repairs from supplies and consumables to capital and cutting back on budgeted depreciation. This is not a sign of prudent management. In fact, it breaches one of the government's fiscal strategies, fiscal strategy number 5, if I'm not mistaken. I'm not suggesting the task the government inherited was in any respects was an easy one. The difficulty of the task, however, shouldn't be the reason to be less than forthcoming about what's actually happening. The government doesn't solely rely on cash inflows and outflows for operating and capital amounts to measure its budgetary position, as does the Australian government, for instance. Instead, as I've mentioned, it uses a measure called the net operating balance, and which includes a few book entries, as I've already pointed out, and can be easier to fiddle. The government is still including capital grants in the net operating figure. This is a misleading point, as I've made this point many times in this place. The government was keen to point out its success in keeping tight control over supplies and consumable spending. Mr President, as we'll all be aware, supplies and consumables is a large catch-all category of spending that includes repairs and maintenance and consultants' fees, as well as medical supplies and travelling. It comprises roughly 20% of outlays after employee costs, 50%, and grant expenses, roughly 20% also. It happens every year, regardless of which colour government is in charge. Supplies and consumables are reduced by shifting consultants' fees to employee costs and repairs and maintenance to capital. It's lauded as a triumph for budgetary management, but it's just a reclassification, and we readers are left a little confused. When it's so easy to reclassify repair as a capital item and improve the net operating balance at the same time, one does become a little suspicious. When capital expenditure needs a boost, any reclassification is actually a win-win situation. I'm not suggesting, Mr President, we shouldn't repair items, but the shifting between repairs and capital makes it hard to work out what's actually happening. Does the government know what's happening? And if so, how do they know? The supplies and consumables amount was less than expected, but employee expenses were $80 million higher. Despite a reduction in employee numbers of almost 1,000, or 4%, employee expenses went up 4%. Mr President, none of what I've referred to is cause for panic, but neither is its cause for celebration. I simply wish to put on the public record that the government has cherry-picked the figures from this year's preliminary outcomes report to include its media release, and the reality of what's happening is actually being withheld from the public. The theory of mushroom production is being repeated yet again. This government has proved to be better than the former government at achieving budgets, but much of the improved bottom line has simply resulted from deferments of infrastructure spending and windfall gains from Canberra. Announcing that the heavy lifting has been done sounds a bit like President Bush's 2003 mission accomplished speech clad in a bomber jacket aboard the USS Abraham Lincoln. Even if it's true, it sends the wrong message. At a time governments at all levels are revealing themselves incapable of meaningful reforms, people are told that everything is under control. The government, to its credit, has achieved budgets. The government, however, has concentrated only on one side of the ledger, cutting costs. The other side of the ledger, the revenue side, is largely ignored. This comes at a time when our biggest benefactor, the Australian government, is similarly predisposed to austerity. This carries a double risk for this state. In the last 48 hours, Treasurer Hockey has outlined the risk with his announcement for further spending cuts to be taken to the next election. And this will inevitably mean cuts to payments to the states. So this is the double risk here for the state. So Mr. President, I'm not advocating a spending spree, but rather an honest appraisal of our system and a plan C to complement the expense deferral, what I call Plan A, and windfall gains from the Fed's Plan B. We are all ill prepared for another shock, a shock that will reduce services below what everyone needs and expects. The government talks about the heavy lifting being done, but in the next breath it says there's still a lot of work to be done. So what exactly do they mean? I hope the government will provide a little more detail about what has to be done, and perhaps more importantly, what it has failed to do, rather than cherry pick a few statistics in an attempt to oversell their modest achievements to date. Mr. President, I do prefer to give credit where credit's due, and I believe I have done that. As I've said, however, though, cherry-picking details in an important report such as this, whilst not new and not unique to this government, choosing only to publicise the favourable aspects and overlook the real detail, does not promote open and informed debate. Nor does it enhance the public knowledge of the reality of the ongoing challenge or the implied suggestion of prudent financial management of the state. This is what the main motivation behind me moving this motion. It's an attempt to ensure a more fully informed Parliament and hopefully public to raise the level of understanding both inside and outside the Parliament. If we are to have a meaningful level of informed debate, a better understanding of the reality of our financial state is necessary. Whilst many find debates and engagement in this area of government activity somewhat dry and in many ways challenging, I'm hopeful that debating this report in the House and engaging in discussions and public discourse will actually see a better informed public and Parliament. We may then see greater engagement and inclusive policy development that considers both the spending side of the ledger and the revenue side. This will assist the state deliver the services we need and deserve, continue to build and maintain the necessary infrastructure in a timely manner, support industry and investment in the state, thus ensuring improved employment opportunities and wellbeing for all Tasmanians. Mr. President, I look forward to the contribution of members to this debate and hopefully a more informed discussion, a discussion that needs to rise above the blame game and adversarial sniping that still dominates public discourse. I note the report.